Hi everyone, and welcome back to the Independent Dollar. Today we are going to take you through a simple step-by-step guide to buying your first home in Canada. The first step is saving up for your down payment. In Canada, the minimum amount you need in order to buy a home is 5%. So on a $300,000 home, that would mean a down payment of at least $15,000. However, if your down payment is less than 20%, your bank will also require that you purchase mortgage default insurance through either CMHC or Genworth Canada. While insuring your mortgage may not sound like a bad thing, this type of insurance is not to protect you. The insurance is to protect your bank if you are ever unable to repay your mortgage. So how much does this insurance cost? Well, if your down payment is 5%, it will cost you 4% of your total mortgage amount. So on that same $300,000 home, 4% on a $285,000 mortgage would mean an insurance fee of $11,400, almost as much as your down payment, and a very expensive fee, especially for new homeowners. This insurance is applied for and set up through your bank, and you can choose to either pay it upfront out of pocket or you can have it added to your mortgage. I'll include a few links in the description below if you'd like to learn a little bit more about this insurance. The next step is getting pre-approved, which means meeting with a mortgage broker or your bank to determine how much of a mortgage you can afford. This is something realtors will want to see before they start showing you homes, because it lets you both know what price range you can afford. This is also the time where you'll start negotiating the type of mortgage you want with your bank. Make sure you stay tuned for our next video because we're going to be showing you the pros and cons of different types of mortgages, and we'll also be sharing our strategies on how to negotiate the best rate and perks with your new mortgage. So make sure you hit that subscribe and bell button so you don't miss out. Next up is the fun part, shopping for your new home. Once you find a realtor that you're comfortable with, you'll let them know how much you're approved for and what areas you would like to live in, as well as the features that you're looking for in your new home. They'll take all of this information into account and start finding you the best homes that match what you're looking for. Your realtor then schedules appointments at each of these homes so you have a chance to walk through them and decide whether or not you like them. In Canada, the fees paid to real estate agents are paid for by the sellers. Meaning, when you buy your home, the person who sold you the home will be paying the fees for your real estate agent. You've been searching for a home and you finally found one that has everything you've been looking for. The next step is to submit an offer to the seller in order to buy it. Your realtor will guide you on what price you should offer, negotiate all of the little details, and prepare all of the paperwork for you on your behalf. On top of negotiating the price and the day you want to move in, your realtor will also be responsible for negotiating some important conditions before you finalize your offer. These conditions are usually things like a formal inspection to ensure that the home that you're buying is in good condition, and also confirming that you can get financing for that home. Even though you've already been pre-approved for a specific mortgage amount, the bank will still want to ensure that they're comfortable with the home that you're buying before they'll give you that mortgage. They will usually send someone to appraise the home to ensure it's worth what you're paying for it and also ensure that it's in good condition. They will also want to confirm any information you submitted in your mortgage application, like the amount of time you've been working with your employer, how much you make every year, and also confirm that you do have enough saved up for your down payment. They will also want to see that you have enough money set aside for closing costs, which we will be discussing next. If you're putting less than 20% down, then CMHC or Genworth Canada will also want to review your mortgage information before they will approve the default mortgage insurance on your application. The final step is all of the legal paperwork. Once you have a firm offer in place, your bank will submit all of the necessary information to your lawyer for you. Your lawyer will then review all of the paperwork for your mortgage and prepare the legal documents to purchase your new home. As we mentioned earlier, you need to ensure you have enough money set aside for closing costs. This amount is in addition to your down payment. So how much do you need? Closing fees include the cost of your lawyer as well as additional expenses that you might have to pay in order to finalize your home purchase, like land transfer tax, any inspections including appraisals of the home, or inspections of a septic system or a well if those are on the property. As a general guide, you want to ensure you have about 1.5% of the purchase price saved up to cover these costs. On that $300,000 home, that would mean saving $4,500 to cover these fees. So in total, to be financially prepared for your home purchase, you need at least 5% for a down payment and 1.5% for closing costs. In this example, that would mean you would need to save up at least $19,500 to purchase a $300,000 home. Now, aside from these, there are some additional expenses like utility setup costs, appliance purchases, property taxes, and other fees that you should be aware of. So head over to our website, theindependentdollar.com, to see a full list of items that you should keep in mind when budgeting for your new home. Hopefully you found this video helpful. We'll see you next week when we start discussing the different types of mortgages and how to negotiate the best possible rate.